History tells us the share market doesn't sail smoothly through September and October. In fact, these months are notorious for sharp pullbacks that catch investors off guard. But here's the thing, not all stocks fall when the market does. Some shine when conditions turn defensive. So tonight we'll reveal 7 ASX stocks you want to own when that pullback arrives. Wealth Within has been the trusted source for decades in the stock market and is the only company in Australia to hold an Australian financial services license along with accredited training program in share trading. Whilst its analysts bring over 80 years of combined market experience, and tonight they'll walk you through which companies could protect and even grow your wealth during the toughest part of the year. Stick with us right to the end because the final stock on the list is one that could surprise even the most seasoned investors. I'm Philip Tortevsky, and joining me are Wealth Within professional traders Janine Cox and Pedro Banales. Good evening.
Good evening. I'm looking forward to being surprised.
Yes, it's going to be a good one tonight. Obviously, we've got September and October on the way, so thank you very much for joining. It's just you and I in the studio, which is quite nice for a change.
Which is kind of weird, isn't it?
Yeah, it's cool.
Got the whole place to ourselves.
And as always, joining us from Taiwan is Pedro Banales. Good, how are you, mate?
Good day, guys. Great to be back on a Tuesday show. It's been a while.
Yes, we're going to get into some great stocks. So let's get straight into it now. This quarter has seen the market provide some amazing gains, but we are approaching the danger months for the All Ords where a lot of the good work can be undone. So what can we expect this September and October, and are we likely to see the market pull back? Janine, I want to go to you on this one. Obviously, we're going to get into the All Ords, but yes, historically, September and October can be quite bearish. We've had 18, 19, 20 weeks up on our market. Do you see a pullback coming?
Do you want the short answer or the long answer?
I've got an hour, so whatever you want.
All right, we can get right into this then. Shall we go to the chart? Okay, let's take a look at the All Ords. Now, the simple answer is that right now our market's in no man's land. And what I mean by that is that oftentimes we see the market slow down or reverse close to these major numbers like 6,000, 7,000, 8,000, 9,000. Our next one is 10,000. We've also got a target around 11,000 as well. And not to forget the larger target that I had for our market, which was closer to 13 or 14,000. That was a stretch target. But for now, given that the market's been up for this many months, normally we start to see the market go sideways and then it will sort of reverse and come back a little bit. I'm thinking right now, given that it's been so strong, that we could see the market come down in the worst case, sort of around 8,500 points. But it may surprise us because we're in this zone where the market is supposed to be bullish, big picture, coming up to an important turn in the market. We think there could be a peak in the market in around November. And it's historical that the market does move up early into November, but we have this volatile time often in September. Not for all stocks, as we're going to talk about tonight. Some are more resilient than others. But if we look at what our market's doing without that pesky box on the screen there, you can see that this strength that we've seen in the last month particularly has pushed us right up through to 9,245. If the market comes back and touches this high here, the prior high in February, and finds support close to that level, I think the market's going to go gangbusters. And what would drive that? There would have to be some change that would drive our miners to go higher. So at the moment we're seeing historically defensive stocks pull back, but our mining stocks are still sitting there with the potential to go much higher. Now, if they have a pullback first, we're going to see an almighty push back up to those prior highs. So I still think that our market's got another bullish run, decent run to go in it. Could be for the next 18 months. In the short term, we're looking at a couple of months up in towards the end of the 2025. But September, I think, there's probably not many arguments out there. If you were to take a tally of whether people think it's going to be a down month, most people think that it's going to be a down month.
All right, so nothing crazy, but expect a bit of a pullback.
That's right. Now, in saying that, sometimes we get a bit of volatility, in October as well. So it might run into early October.
Great. All right. Now, I want to dive deeper in terms of what areas of the market are the plays for September and October. If history holds true and we do see a decent correction. Now, Pedro, I want to bring you in, mate. Obviously, look, we look at that chart and it's definitely green, green, green. The market's up about 28% from those April lows. History says even 03 to 07, the big bull run, that a pullback is coming after a 25, 26% run. So what sectors are the ones to play during September and October to potentially get some gains even in these down months?
Well, Phil, it's really about being stock specific, and there are some sectors which generally do well in many months of the year. I mean, you've got the financials, a few of the consumer discretionary sectors do quite well. I mean, for most months. But really, this is why it's so important to be looking at this seasonality type analysis as we have. And we're going to get into that, the stock specific sectors and analysis that actually show you the positive versus negative months on each individual stock. And that's what really where the real value is. So we've got some exciting analysis coming up on that, which I'm looking forward to presenting.
Yeah, well, all right, let's dive into the first lot of our Q3 ASX stock winners. However, stick around though, because after this lot, we'll get into a story that just broke today, which has massive ramifications for every Australian. And then we'll reveal the next lot of stocks, including one dark horse. You won't want to miss this. Now, Janine, obviously, Pedro did mention, maybe I'll refer back to him. We did build a bit of a watch list to break down which stocks are looking interesting. Anyway, enough of me talking. Pedro, maybe take it away and give us what you've put together.
Well, first of all, I want to thank Darren from Optima for helping us to put this together. Great support there from Darren, as always. This is a comprehensive analysis that we have here. So on the screen, you will see that we have a watch list of the top 100 stocks. And we've broken down which months of September, of course, were positive and which were negative. So if I can, divert your eyes to the right-hand side where there's this chart, and you can see that there's the green arrows pointing to the positive months and the red arrows pointing to the negative months. Now this, we've converted it into a ratio, which is displayed here on the watch list for all years, 10 years, 5 years, 3 years. And the last time that September has been a positive month. So if the ratio is above 1, then that is mostly positive. If it's below 1, then the negative months overtake the positive months. So we're really looking for the stocks that are displaying in green and that are above that 1% ratio. And you can see there's more detailed analysis here on the bottom right hand side, which I won't get into. Basically, we're looking for those green ones. And I've actually sorted the chart, the watch list by the last 5 years. So which ones tend to be mostly positive in September over the last 5 years? And you can see we've got, Saul Patterson, Technology One, Telix, Suncorp, and all that. And then you've got, when was the last time that they were positive in September? And all of these top ones were positive in 2024. So, with a high degree of probability, we can say that they are going to be positive this year. Now, we've taken it a little bit further. And we've gone into the October months as well. So which ones of these stocks are not only positive in September, but are they positive in October as well? And we've compiled the top 10 here. Now you'll notice that zeros here in red during September. But the reason why I put that in there is because it's just so positive in October. I mean, that ratio 4 times over the last 5 years, 4 times more than negative. That is very strong. So this could be one to be picked up early in September in kind of anticipation for October, I should say.
Yeah, fantastic. I can see you've done a lot of analysis there, but I know everyone is chomping at the bit to get into some of those stocks. You mentioned some good ones coming later on, so stay tuned for the later stocks. But right now, let's get into the first lot. Janine, what have you got for us?
Okay, now Technology One surprised me that it was on that list because some of the tech stocks tended to get stung during September, October. But as we can see, if we look at the chart, that this one's held up quite well over time. It's really been just going straight up. If it does pull back, it just tends to go sideways. We can see there August, September, October, it seems to be sideways in nature. This was back in 2023. And if we come up to 2024, we can see not huge months, but it wasn't falling, right? Yeah. So therefore, we've had a couple of months down already in July and August. So perhaps it will just stay sideways, as historically it seems to do, and that's technology one. But I mean, the setup that we're seeing here, if you look at this little setup on the weekly, if that holds and then it breaks out of that, that could actually bode really well for the next move up for technology one.
Yeah, it's interesting because, you know, right now you're asking that question, okay, on one hand it's protection to some degree, you know, how do people protect?
How do you keep stocks in your portfolio that are going to be more defensive rather than get these huge volatile swings or be exposed to those massive swings? Now, the reality is you're not going to get all of them right. That's the reality, but it's about having more of those in the portfolio than the ones that are likely to get hit hard.
I mean, is there even possible to add an additional portfolio perhaps and say, all right, I've got my long-term portfolio that I have here, and this is potentially some kind of hedge I could use to say, I'm going to open up another little portfolio, add some stocks that generally do well in September and October, and that might offset some of the, I guess, losses that might come if the market does pull back with those bigger stocks. Just thinking out how people can really play with this.
That's a really good thought. It just opens up a whole other area. And I mean, really, you need to have a lot of experience and education to know how to run those portfolios side by side and to do that hedging strategy that you're talking about. So it's about picking them technically, not just picking them for the fundamentals, but a combination of both that's so important. And I've been having conversations with people recently about fundamentals, and they're saying that they now can see that even though fundamentally they're picking the good stocks that go up and they're able to make a profit, they're not able to hold on to them for some of these runs like we've seen on Technology One.
Yeah, I mean, perfect example is what's been happening in the healthcare sector over the last couple of days.
Exactly.
It's been absolutely crazy. All right, let's get to the next stock.
Yeah, the next one we've got is Qantas. Now, this is really going to surprise a few people that Qantas is one of the ones that made the list. But, I mean, historically, Qantas has had a checkered history, but it's performed so well since COVID and it's continuing to make new all-time highs. And I think in the short term, while Qantas may actually pull back, I think it's nothing to be worried about unless it falls through this low in June. That was week ending 27th of June 2025. And the beautiful thing about it is the way that it's unfolded, you can fit a trend line underneath it. And some of the stocks that you historically thought, you know, you couldn't do this to, or we're just waiting now to see if we can get another line up underneath that. But that's sort of the angle of the trend that's been going for Qantas. I think Qantas is transformed. You can see that by the chart. It's so far removed from where it was back prior to COVID. It's not funny. And I think that this is one to watch. A lot of people said, oh, I wouldn't have Qantas, you know, an airline in my portfolio because it's too risky. But how many times do you hear of, you know, Qantas flights crashing? It just doesn't happen. So,
yeah. But I mean, to me, it raises an even more important question because, like, and I'll get your input on this, Pedro, here to answer, because you're dealing with, you know, our students all the time. But it speaks to be able to do this, we're talking about timing to some degree. If you're looking at nominating a specific time of the year where you might find those opportunities, the skill set needed is, as you've got it, looking at that chart to identify the when, because that's what the chart's going to give you, the when, and that's really what we teach out here at Wealth Within. So I want to get your thoughts on that, maybe expand a little bit, Pedro, in terms of this strategy, because we're going to get the stocks, that's great, but looking at that strategy itself, knowing technical analysis the way we teach it, and also knowing the timing of things, what you're trying to achieve on these charts that we're showing, that's the key to getting this right, isn't it?
Yeah, well, that's a good point. And really, I've lost count of the amount of students that I've had a phone call with that have come to us, and they actually made fairly good money out of the COVID low. They did recognize that opportunity, you know, to buy at that low point. But then, unfortunately, they couldn't hold on to those profits, you know, when we had that crash, you know, in 2022. A little bit of, you know, minor crash, but still a crash in that. So, you know, that's where the timing of things comes into play. And really, you need to know how to hold on to those profits as well. You know, it's easy to buy and push the trigger, but selling, that's the real art. So definitely this seasonality comes into play, but then there's also other layers into it. And what we teach in the course is how to do that analysis from the beginning to the end, how to identify these opportunities and then go stock specific and identify those entries and exits. So definitely this is in line with what we teach at Wealth Within.
Yeah, fantastic. All right, how about you tackle the next stock? Janine's had two. What's on next, mate?
All right, I've got Pro Medicus here. So this one's had a huge run. Now I've got the seasonality up here just to show, just those arrows that I was pointing to before. Just gives you a bit more of a visual on the September positives versus negatives, and you can see that September is usually a precipice to a fairly nice run. We can see back here in 2018, September was positive, and then we had that beautiful run. Then in 2020, September was positive. Then we had a nice run. Again, 2023, nice run. And then more recently, 2024, nice run. Now, this one is pulling back. So I'll go to the actual chart of it and we'll go to the weekly, because this one might be looking interesting. This could be forming a similar pattern like it did back here in May 2025, which is just a bit of a pullback before the next run up. So this one is definitely one to keep an eye on. I would say that there's solid support around that level, around that 300. I would say more, to be more precise, 298. If it can hold above this level, then break above that all-time high, then we might be, in for a new bullish run. So this one is looking nice. It could be a nice short-term trade if you were to be able to pick it up in September. We've got 11% to that previous all-time high. So interesting. This one is definitely interesting.
Yeah, great. All right. Now, while you're at it, maybe get to the next one. Given Janine's had two, you can even the score.
Yeah, sure. No worries. So let's have a look at Hub 24, and we'll just I'll expand out that chart again, showing the positive versus negatives, and you can see clearly here on the visual that the positive and negatives. Now, it's important to note how I would say how high those moves are, because it could be a positive month, but it could be something little like this one back in 2019, where the open was fairly close to the close. So this one, it has run a lot like PME. It could be due for a bit of a pullback. I think that this one is a bit extended. If you're not already in it, I wouldn't be jumping to get into this stock. It looks like the final kind of move before we see a bit of a pullback. We've got a gap here on the weekly at around that $87. So it could actually come back to fill that, which is around that previous all-time high level, around that $92. So my take on this one, yes, it's good. It's performed well, but I wouldn't be jumping on this one at the moment.
Yeah, what I find quite interesting about all four of those stocks, momentum's with them right now.
They're all strong.
Strong.
Yeah, so I mean, if they come off a little bit, it's not the end of the world, is it? It's not like CSL, say, that recently's taken out a new low and it looks like it's going to continue to fall, but they've held up so well, these ones.
Yeah, and I mean, you saw it back in 03 to 07, stocks trading at all-time highs, huge momentum, really strong. You look at it and you think on one hand, oh, it's a bit stretched, but they went on for another 2-3 years.
Yeah.
Some even way more, like especially the material stock. So it kind of bodes well with what you're saying in terms of...
It's interesting.
Yeah, real interesting.
Really interesting research.
Yeah, all right. Well, that is it for our first four stocks. Now, the best are yet to come, so stay tuned. But now it is time for our trending topic of the week. Janine, this is a big company, big news. Big
news. Now, Trump tariffs hit Amazon and online Aussie businesses. Australia Post is freezing parcel deliveries to the US while it comes to grips with more tariffs. Trump called the shipping of duty-free parcels a catastrophic loophole, and I'm going to say it in Trump fashion. I won't do his accent.
Please.
No. In his order last month, saying it had allowed packages to evade tariffs and fuel deadly synthetic opioids, as well as other unsafe or below market products that harm American workers and businesses into the US. What the? Amazon had earlier postulated about displaying the value of the tariff on its packages. That makes the interesting story there, I think, all in itself. Right before President Trump reportedly contacted Amazon's CEO. The story gets interesting, doesn't it? But the latest change weeds out lower cost competitors for Amazon. There's another twist to the story everybody's interested in. Australia Post's decision is going to hurt small to medium-sized Aussie companies. That's the hard reality of this.
So for a very long time now, the US has had a trade exception. So if you've been trying to send anything below the value of 800 American dollars, if you're a citizen or a business, you've been able to send it into the country without a tax. The Trump administration has now removed this. They've dramatically lowered that number to just 100 American dollars or 150 Australian dollars. What does that mean for you first and foremost? Even if you want to send a gift to the United States worth more than 150 bucks, think again. You will not be able to do that from this point forward. This will be a big blow for Australian businesses, particularly small traders. They will no longer be able to send goods to the United States worth less than $800. So anything above 150 Australian bucks, they won't be able to send that to the United States. Australia Post confirming this just minutes ago, following countries like South Korea as well as the United Kingdom, all because the Trump administration has changed these rules. So certainly a tough time for Australian business. This is essentially another trade tariff placed on our country. At the moment, though, letters will continue to be flown to the United States, but that's just about it.
Interesting stuff. So how is online retailer Amazon holding up?
That's the big question. But I mean, you know, it's quite alarming what's happening because it's going to hurt Australian businesses. We know that looking at the numbers, the unemployment numbers, although down, a lot of that is coming out of government jobs, almost 80%.
It's huge news.
And this is another whack to businesses.
Fashion retailers are going to be hit.
Yeah.
There's a beauty companies online stores. We've got some of those listed on the ASX, which you may be holding. So that's something to think about. Have a look through your portfolio and make sure you do your research. But Amazon, if we go to the charts right now, we can see that it's really looking unaffected in all this at the moment anyway.
Well, and maybe give us a bit of the insight into why obviously Australia Post is the one that's copped the news, but we're looking at Amazon because they potentially now...
Amazon are probably better off. Like they're able to absorb the cost because of the size of the business. And then that means that if they're absorbing the cost, well, which companies are not able to absorb those costs? Those companies, they just get done in these sort of environments, and the big fish always win out, and that's the issue. So Amazon probably is going to be looking sweet. I mean, they can afford to pass their costs on to consumers. One thing I don't get, even though Amazon's convenient, you're selling out your soul by shopping with Amazon, use your Australian online retailers. But let's go to the charts. All right, so Amazon, if we're just looking at the chart here, some of you may hold American stocks, but I just thought it was interesting to take a look and see how well this stock is holding up. Now, we know that it's actually had a decent pullback from February through the tariff announcement into April. Notice how it was already falling prior to that, which was quite interesting to me. And it fell quite significantly into that low. If we just have a look at the percentage fall, it's probably pretty normal. Once a lot of companies fell that sort of order, 33%, it came back below those highs, finding support. But to me, this still is a setup for much higher runs to come for Amazon. If we look at some markers and draw some lines in the sand, which is really important to do on your chart, we can take this low here and say, well, if Amazon takes out that low and continues to pull back, there are going to be some much better opportunities to pick up Amazon. But if it takes out this high here and challenges the all-time high, well, you know, it's blue sky we're talking about for Amazon. And, you know, it doesn't take much to think, well, could Amazon be worth 300? Sure.
Yeah.
Into the next year or two.
Definitely one to watch. Maybe even some online retailers like Kogan might be.
Kogan's a really good opportunity to have a look at, and there's some beauty online retailers, but there's a lot of online retailers that ASX listed stocks that are actually not affected by goods going into the US. So that's why you need to do your research.
All right, something to watch. Now, if you want the skills to analyse stocks just like you've seen tonight, visit our website, wealthwithin.com.au. But let's now get back and uncover some more stocks that have the potential to not only hold up during September and October, but win big. And right after that, we're going to get into some other major news on one of Australia's biggest miners. So stay tuned for that. But Janine, the next lot.
Now, this next stock is probably not going to surprise too many of you because it's a bank, which tend to be more stable in these times. So if we take a look at the next stock, it's ANZ. ANZ was a bit late to the party in terms of taking off. It's still well below its all-time high, as you can see. So let's just have a look at the potential here. It's still got another 11.5% to go to get to the all-time high, and then beyond that, you know, we're talking about $42 potentially above that as well once it gets through to that all-time high. But I think ANZ's looking quite nice. It's broken up beautifully. It might have a little bit of a pullback just to test the recent run, but you know, you can't really scoff at that, can you? It just looks fantastic.
I mean, how often do you see that? It's a stock, ANZ, probably not, when you look at the price action, it's not as clean as maybe some of the others, but we're talking big stock, safe stock.
Yep.
And you look at some of these...
huge dividends, good dividends once you take into account the franking.
Yeah, and then you see these patterns that continuously unfold. Patterns that we do teach, by the way, and you know, you see what's happening right now on that big picture time frame with ANZ. It makes sense that what it's doing today was supposed to happen, basically, right?
Yeah. I mean, the thing with ANZ is once it starts, you saw this run here going up into the high prior to 2015. That was prior to the Royal Commission. And then we've got the one prior to the peak with the GFC. What happens once it starts taking out these highs, this high here, say June 2002, which was what we've just seen. We've seen it take out an important high here. Then it starts to get into one of these sort of rises where it just starts to take off. And ANZ will repeat what it's done in the past. So that's what we're expecting going forward from ANZ.
The meat of the trend, as they say.
Exactly. There's big money to be made in banks.
All right. Pedro, next stock?
All right, next one we have is Xero. So this is the one that I mentioned that it does have a slightly more negative September, albeit not that negative, but a very strong October. So this is might be the time where you should be positioning yourself. So let's get to the chart of Xero, and you can see I've got the monthly on the left, and really the level that I'm looking at is at 156. The stock is trending down. So far for August, we are closing on its low. So that's showing a bit of weakness, but it is heading down to that level that I've marked there. So if we go from the close, we've got about that 5% till it reaches that level. I think that that is quite a strong level. And if we couple that with a nice trend line, or I would say, you know, more momentum type of line, then we do have a cross section here that's adding to the confluence, you know, that price is going to find support. So we could have a bit of a down September, but if you manage to get in, then you could have a nice run, you know, all the way to the all-time high, about that 25%. And we know that this one is a nice growth type stock. It has been for a very long time, and it has outperformed, you know, time and time again. I mean, have a look at that. This is the weekly chart there. And I mean, interesting the type of pattern that it's unfolding. You know, our advanced students would find this very interesting. And I think that this is a great stock to actually learn patterns on, because it does them time and time again. You know, just recently from this 2022 low, we've got repeatable patterns here, and it looks like it may be setting up for the next run up. So I actually quite like this one.
Fantastic. All right, we've got one more, Janine. And
all right, Aristocrat Leisure, like with tech stocks or any of these type of stocks, like the one that Pedro had up before, you know, they can be more volatile. So it takes confidence to be able to make a decision to buy and sell these ones. And that's where, you know, this is where having those rules checked and tested and knowing how to apply analysis so you can determine what's important. One of the biggest things that people find a challenge is working out, well, if a stock goes through its all-time high, how high is it going to go? Now, for anyone who comes through our courses, it's a no-brainer. You just apply what you've learnt. But for someone who hasn't done that, they've got no idea about what the potential is. So with Aristocrat, if we look at the chart of that, it's only about 11.5% from the all-time high and looking very nice, having moved up just recently. And if we go to the weekly chart, what it reveals is the strength of this level that it's recently broken, which it may come back and test. But that's not the issue. The issue is more bigger picture, as we saw. The potential. Stocks are hitting $100. Have you noticed how many stocks have either gone through the $100 or they're trading up to around those levels, $200? This is where Aristocrat hasn't even cracked that level yet. It's still below that level. So I would expect that we see a little bit of a pullback maybe in through September, but more stable, and then to see this thing take off again. We've seen what happened in 2024. And in 2023, it was more sideways. We saw Hardly a pullback there, and then it actually fell down in October. So it might actually be October where it pulls back a little bit more than September. It might hold up nicely, but we'd welcome it, welcome the pullback and then see it launch off from there.
Yeah, I think the most important thing about what you've said in knowing what happens past the all-time high or being able to measure it is plays into that let your profits run, cut your losses short. So often, it's traders cutting their profits short, letting their losses run. And that's because, having that ability to project what comes next or how far the stock can actually go. So if you do want to know how to cut your losses short and let your profits run, get this book, How to Beat the Managed Funds by 20%. It's Dale's book. It's free. You just have to pay the shipping. The link is in the comment section in this video below. It's got portfolio creation, all the stuff we talk about and show on this show. And if you want to take things to the next level, take your trading to the professional standard, go and visit our website and check out our trading courses under the education tab. Now, moving on shortly, we have massive news coming out of one of our biggest retailers. Now, the share price is bursting higher right now, so is it finally time to join the party? We'll find out shortly, but first, let's answer your questions. Charlie writes, I manage a SMSF and buy stocks based on fundamentals. I check 20 metrics, for example, the PE, DE, free cash flow, net margin, ROE of a stock before picking them. Now, once the stocks grow 15%, I sell and buy another stock. Although this rotation strategy does produce very good returns on an annual basis, I sometimes repent that I may be selling too soon. For diversification, I limit my investment in each stock to be not more than 2%. How can I fine-tune my strategy? Appreciate your thoughts. Well, I think we just spoke about it a second ago, cutting your profits short and...
Well, it's not just that. It's also how much is he investing in each stock? So does that mean he's saying that he's limiting his investment to 2% or his risk? I wasn't quite sure about that, because if he's got a portfolio where it's 2% of his investment, do you know how many stocks he would end up having? I mean, it's just crazy. Why would you even go down that path?
And the cost of all that, the commission.
Yeah, and then you don't end up making much overall on your overall portfolio if something does really well, and he's limiting the upside, as he said before. But all he needs is just to be able to, it's the fundamentals. It sounds like you've just got an edge where that's concerned, but you need that additional step to get the course that we teach so that you can actually get your head around the technical side and learn how to set proper rules so you can stay in the stocks long enough and reap what you've actually, all that hard work that you've put into the fundamental side, you're missing out just because you don't have an understanding of the chart. So really important. And he's not the first. There's so many people I've spoken to recently who are in that boat and they're looking to do our course to get that advantage.
Yeah, I think the times are turning.
Can I also jump in, guys? Because I want to say that this person has the potential to be a very good trader. On the positive side, I love that he's actually got a strategy in place. He's looking at the fundamentals. He's objectively taking that profit at 15%, which is not the best strategy and it's not what we teach, but at least he's got those hard set rules in place. Now, with a little bit of fine tuning, like Janine said, and knowing how to read a chart, I think that he could be a great trader and a great investor because he's already got the fundamentals in place. And it's something that many people don't have once they enter the stock market.
And it's more the discipline, isn't it, really, is what you're saying, Pedro. He's got the discipline to actually follow through with trades. He just doesn't have a good set of rules. That's really what you're saying.
Exactly.
Yeah, I think the tides are turning, right? I mean, traditionally there was this whole, you're either a fundamental guy or you're a technical guy. Each hate each other. But, seeing the value, I think, you're playing with your hands tied behind your back if you're just doing one way. So, yes, please go and check out that website and those courses. They will help you a lot. Now, anyway, next is Chris's email who says, can you have a look at GQG for me? There's not much to see on the monthly, but I think the weekly looks to have formed a solid support at $1.785, a level that spent nearly 2 years providing hard resistance. There's a pretty good trend line from the July 24 high. I feel like this must be coiling up for a breakout. I've also read several positive reviews on it, and the dividend yield is 12%. Now, that is quite nice. Pedro, I'm going to go to you on this one. What do you think about GQG?
Yeah, well, I kind of smiled when she said that there's not much to see on the monthly chart. I would actually argue that there's everything to see on the monthly chart. Let's go to that now, because I have highlighted this level here at 1.55. Now, anyone that knows that level or what that level means will identify that that is the strongest level on this stock right now, and it does look like it is heading back down that way. So really I wanted to highlight the importance of going to the monthly chart, because this is going to give you that initial analysis of where you should be looking bigger picture. And if you look at that, you can see that the monthly is closing down. I mean, everything is pointing down to this stock. The fundamentals may be good, and I know this stock personally. I have had a look at the fundamentals, and I agree. It's a capital management company. I think that they've got good management and great potential moving forward, but just not right now. And I would be more interested once it gets down to these levels. So we've got how much? Around that 10% down to that 1.55 on the weekly chart. I don't agree that it's got a pattern or a setup at the moment. Everything is pointing down. Not support. It's actually broken that 1.78% support. You might have these previous peaks and troughs back here, but again, that is around that, say, at least that 1.65 to 1.55 level. So this for me is not it's just a not yet, but a definite watch for the medium to long term.
Great. All right. Now, Michael writes, I hold CXO, which I purchased back in 2021 for 70 cents. Yes, I held on too long and missed out on the profit at $1.60 in late 22. I've just recently purchased more CXO for my wife and paid 12 cents. My question is, what are your expectations for the share price of CXO in the next 12 months? All right, Janine. Now, again, something we also see, typical traders holding on to a position for too long. I maybe won't say dollar cost averaging because it's picked up for the wife, but buying in again as it's falling. Outlook on the next 12 months and also a little bit of insight on that type of strategy.
Let's have a look at the chart. All right, so what you can see here is the big decline on core lithium. Now, I'm not going to give you a hard time about where you bought it. I know that if Dale was on the show, probably would. However, what I'll say is it's a lesson learned. But the thing is here, lesson learned, but then have you doubled up on that mistake? That's the real problem here, because one, you've held on to something, okay, it's worth almost nothing compared to what you bought it. Then you've just got to decide, well, once it bottoms out, are you going to keep holding it? What point are you going to sell it? You still need to have that in mind as to how you're going to manage that initial position. The second thing is and this is a mistake that a lot of people make that come to us, so you're not alone, and we've had stories of people who've turned this whole situation around, big aha moments once they come on board with us and we look after them. What happens next is that you've got this position for your wife. Now, the problem here is if the stock takes out this low, and don't think that a stock can never go lower, because it can, and that's the whole problem. Because it's already been down at this level before, it's not to say that core lithium couldn't come down and hit that level again. It could. But at the moment, it's making higher lows, which is ticking a box. That's the first thing. The next thing is hurdle. It's got to get above this high in October 2024. If you bought this now, you have to have a plan to manage your exit. You've got to have a set of rules. Even if you did the Trading Mentor course, you'd have a set of rules. You've got to have something to manage that downside risk. So I hope that you've actually set a stop loss, because this is, happy wife, happy life we're talking about here right now, which is far more important than your ego, which may have driven you to go back in again. So looking at this here, you can see it's a 30% fall to that low. That is the big conundrum for traders in terms of trying to make a decision about how to set a stop loss on the stock. So it's like, do you take a bigger loss potentially to manage it, or do you stick to a standard stop? The only way you can answer that is if you know how to backtest a stock, my friend. So that's really the skill that you need to learn to really manage this trade well. At the moment, it looks good. I think you're probably just going to have to contact us and invest your funds in your education. And also, you can write back in anytime you like.
Yeah, fantastic. I mean, it's a real interesting point. We'll move on, but just to, there's
that was sort of a bit of a hard lesson. I didn't want to be too hard on him, but at the same time, I think it's a really important turning point in his whole trading right now, given what's happened.
Because there's no guarantee that price will move back up to $1.07. It might, But, you know, are you going to be able to manage that? That's the most important part. Do you know how to read price to manage whatever comes next?
Yeah, because imagine you've lost on the first one,
Yeah.
you've kept that open, and then you've got the second one, and that tanks as well. Where are you?
Yeah, because then what might even, you often see also sometimes it gets to halfway and now you're at break even and they close the trade for there to be no reason to close because it's still moving.
Yeah,
So it's like,
they've got no rule to manage it up well.
no plan, yeah. All right, well, there you go, Janine. As Janine mentioned, give the office a ring. That will help you out a lot. But anyway, Nick is next and writes, following last week's reporting, CSL has been sold off quite heavily. I'd say very heavily, Nick. I noticed that this kind of volume often signals exhaustion in the move and can precede a reversal. With the recent low that has been broken, the question is whether CSL has now been oversold. So it would be good to get your thoughts on whether this looks like a short-term overshoot or a more sustained downtrend. Now, Pedro, I'll get your thoughts on this. Obviously, massive news, CSL reported was down almost 20% in a day. Is it an overshoot? Is it likely to recover? Or do you see further downside?
Well, I mean, this was huge news for CSL. They've basically split in half. They have diverged their, one of their most profitable segments, which is listing separately on the ASX. So basically, it's up in the air. How do really the fundamental analysts analyze this? And it's a totally different company now. Now, from a technical point, it's a falling knife at the moment. It has broken below that long-term pattern that we've been seeing, and we have been waiting to see whether it breaks to the upside or to the downside. Now, I would ask the question, right? If you saw this same move, but it was to the upside, right? Say something like this, and you saw it break out of this pattern and breaking above, would you be thinking that it's bullish? Well, I think that most people would be thinking, yes, it's bullish. It's broken out of this sideways consolidation and it's heading up. Yet it's done that to the other side. It's done that to the downside. So we need to assume that the probability is to the downside. There's nothing to tell me right now that this stock is going to have a turnaround. You're trying to play the arbitrage. You're trying to play the, kind of like that scalping. And that's a very dangerous game to play. I would say that it could possibly come down to this level even, 174, which is around that 15 to 20% downside. Now, if you're willing to hold on to this stock, long term and go through that 20% downside, that's up to you. But that's not how traders do it. We trade on confirmation, not speculation. So for me, this is just a sit and wait. I don't see this stock, presenting anything in the near term, unfortunately.
Yeah.
Can I just make a comment? The interesting thing is with companies like this, I mean, this is a huge company on the Australian market. And a demerger means that essentially it gets smaller because you've got two entities that come off that. So shareholders don't lose; they get a part of each company depending on how the demerger happens. So it can mean sometimes that institutions view that as too complex. We're not holding on to it; it's gone, right? But that can be a temporary reaction to the situation until the market sort of adjusts and works out what this really is going to mean. Because ultimately, usually the two entities on their own end up being worth more than the one individual when it started. That's the thing. So that's something to bear in mind. That
Fisher and Paykel Healthcare.
Yeah, look, Wesfarmers offloaded Coles many years ago. I mean, there's heaps of companies that have done this. So I don't think that it's the worst scenario there is, and I think that CSL's at a really strong support level, but the risk is it could go down to where Pedro's talking about in the short term.
Yeah, all right, one to watch, definitely. Now, John's email is next. I've recently noticed that CAR has been in a steady climb and continues to progress in an upward trend. There are some falls in their share price, but still they continue to climb. I looked at the company structure and it intrigued me. It resembles an ETF in structure and has interesting different characteristics between each scope of services they offer. Now, this is an interesting email, Janine, because likening a stock to an ETF in structure, I'm not so sure what he means by that, but...
I'm not sure what he means either, but I mean, I would never sort of put in parallel an ETF and a stock unless it's a massive conglomerate. Like Wesfarmers used to be a massive diversified company that was in mining and everything,
Yeah.
Some of those companies, you could consider that, and they tended to be more defensive in nature That's how the market looked at it. But in this case, I don't think so with CAR. I can't sort of understand where that's coming from. But what I can say is that it's been incredibly defensive during this time, and it could continue to do that given the big rise that we've seen in the share price. So it may still come back with the pullback that we're expecting in September and possibly early October. But hey, you know, why do you want to sort of quibble about what it is? It's more about how are you going to make money out of it? That's really the point, isn't it?
Yeah, I think maybe, you know, reading between the lines is probably thinking, well, you look at the, you know, American SPX, which is probably the most popular ETF, and that's looking right slanted at all-time highs. Maybe thinking similar type trajectory, maybe. And
maybe he's thinking it'll be safer, like, you know,
yeah,
the
that's
questions
the point.
asked out of fear rather than, you know, it's either fear or greed often that questions come from. So is it the fact that it's more about, you know, you're concerned, is this going to be more stable or is it a safer company to get into?
It's a stock, so I would say it's got all the risks like every other stock does. So
have the right rules and you can protect yourself, right?
Absolutely, yep. Great points. All right, now Kim's email is next. A couple of months ago, you reviewed James Hardie and recommended a buy on them with the recent correction they have experienced. Would very much appreciate your opinion on what we might expect, please. Now, James Hardie recommending a buy. I mean, we don't recommend buying or selling on this show. We recommend whether it's going to go up or down. That's the first thing, Kim. But I mean, looking at James Hardie, I'm not sure.
Well,
that monthly chart tells me nothing.
We did have it as a stock that we thought looked like it's starting to come off a low. I mean, it was coming up, it had started to move up off this low. It was making higher lows, but the challenge we'll always have, and this is one thing that we always put in to safeguard us when we're looking at how a stock might unfold, is looking at the trend. And I mean, you can see here that it's below the angle of the overall trend and below, you know, this steeper one that's come down here. So it's possible that the stocks just come straight up to the angle of that run and then hit the line and then got sold off. It depends on where you want to draw, you know, your line, how accurate you want to be, but could even say that it's just traded through it, then reversed. But all the while, good rules are protecting you from jumping into a stock like this, and now it's taken out that low. So when I saw that fall, I thought, because it came up on our watch list, I thought, hey, this could be an opportunity if it starts to move back up. But all of a sudden it reversed and went down. I thought, well, there you go. You know, that's why it was still on that angle, that telling us that, hey, there's something else to watch here.
Yeah, and just quickly, there's a reason why we look at the big picture time frame first, because when you go to that monthly chart, you can actually see that there's no confirmation there as we teach it. So that's the first point, you know, no confirmation to say the reversal's in. And I can also see on that weekly chart, there's a massive gap to exactly where it got to and then fell off. Yeah. Which is another very obvious tell.
So it filled that big gap on the downside.
Which oftentimes can be the end of the run. Two very big signs why this one long-term, you know.
Well, would I still have this on the watch list? Definitely. It's a good stock to have on the watch list unless you've got any sort of reservations about the company itself. You know, that's one thing that some people don't like certain stocks because of their, you know, what they're into. James Hardie hasn't exactly had the best history, but looking at it where it's coming back to, it could take out that low there in December 2022, and that's the risk. Until it turns around, just put it on the side list.
Sit and wait. All right, Ben now writes, I would like you guys to have a look at Green Critical Minerals. I was lucky enough to buy this stock back in December as wild card based on fundamentals. I really like the direction they are going in, so could you please give me some insight on the amount of volume that has spiked in recent months?
Yeah, well, that's interesting, isn't it? When a stock transitions from a decline to a rise, often you see these changes in volume because there might be some institutions that are picking up smaller stocks, the ones that invest in that area. So if you just have a look at the chart, you can see where this has happened. So we've seen this decline. You can see the volume was so patchy, there was nothing there. And all of a sudden it started to turn around. There was interest there in January 2025. We've seen volume quite changeable, but as it's rising, volume's been better. So this is a good sign of a potential turnaround on a stock. Now, it's still a very small stock, still high risk, very high risk, given the way that it is. And a lot of people don't bother trading these for that reason until they turn into bigger stocks. But there's a lot of overhead resistance, as you can see on that chart, for this rise. If you're in it, you could just trail the stop loss up and try to get a run on it. Wait for a run to happen, but you have got to set a stop loss on this thing.
Yeah, and I want to get your thoughts on this, Pedro, because you delve in the small caps a bit more. But I mean, following what Janine said in terms of, it is risky trying to trade this stock, and maybe elaborate a little bit on that, because for me, when you're looking at this, yes, the way it's rising is nice right now, but tomorrow this could be down 50, 60, 70% on, within seconds. So is that the risk itself, that you're not going to be able to get in and out, or that it's so volatile? Or is it purely, okay, if the price action is showing signs, then it's okay for some to trade?
Yeah, well, there's multiple risks involved in trading a stock like this. I mean, we're talking about a 2-cent stock. There's news, there's liquidity. Are you going to have a buyer for your share? Basically, when you want to sell it, there's a volatility of it. It's big spikes in moves followed by big down moves as well. So this is not one that you'd put your nest egg into it, but it may be one that, with a bit of research, you do have to have more research when it comes to these stocks. Know the background, know what they're doing. I like this stock in the way that it's in the mineral space. So it's in the green energy. You've got that kind of the tailwind behind it. Of the rare earths and things like that. So the mega trend is on its side. Now, I've marked here where he has bought roughly at around in December at around 1 cent. So he is up a considerable amount. So I don't see any reason why to be getting out of it at the moment. I'd just be sticking with it. I think that he's done great to be in it. Don't expect this to do this all the time though. That's one thing that people might get lucky, or they might research one of these stocks and then have 163% and think that they can do that all the time. Unfortunately, that's not the way it goes. So, I like it. I think there's, volume coming into it. I think it's looking good. Just stick with it.
Yeah, fantastic. All right, now time for our hot stock tip this week, which is, Pedro?
All right, we've got Coles as a hot stock tip for this week. Now, who would have thought, a defensive stock like Coles would be a hot stock, but it definitely is. I mean, it's up in the manner of 8% just today. They've come out with a report. If we go to the chart, I've got it laid out there. So they've got their full year 2025 results. Sales revenues rose 4.3%. E-commerce sales jumped to 24.4%. So this is in line with what Janine was talking about. With that whole Australia Post and delivery type services, that these consumer discretionary type companies, they're moving more online. So expect to see that rise even more in the future. And of course, they've come out with a 64 cents per share, with totals at around that 3% dividend yield, which is not much, but it's a nice little bonus as you're holding onto the stock. Now, monthly chart, very basic. This stock came out, it IPO'd in 2018, which is when they diversified from Wesfarmers, and it's trailed sideways for a very long time. It really failed to get above that $19, but I do like that now it is trading well above that $19. Today it's up to around that 22. So I would have expected maybe a bit of a pullback to that long-term trend line. But it looks like we're not going to get that. I think that now the stock is off. It's taken off. I don't think that we are going to really get that pullback that we wanted. So on the weekly chart here, just wanted to highlight these patterns, repeatable patterns that we've seen. And of course, today, since it's up, around that $22, then we have seen that breakout out of that pattern, which we've seen time and time again. So if we go by the percentage amounts, usually out of these patterns, we are seeing around that 13%, from the top there, around that 16%. So if we were to project that out, say at least another 15 to 16%, then we're looking at least to that $26. That's where I would expect this stock to go in the short to medium term. And then after that, I mean, the sky's the limit. Have a look at that. We're at blue sky once we hit that $26, and who knows where this stock will go. And of course, we do have our levels, as we teach in the course, how to project out levels in the future where the stock might find resistance. But really, you'd have those levels there anticipating an exit. But I mean, this one is pretty much ready to go. I would think that this is a good medium to long-term play moving forward.
Fantastic. All right, now if you want more from us, check out our video, Best Hidden ASX Superannuation Stocks to Buy Now.